contrarian, leave it to contrarian badass Reggie Middleton. He called the housing crash. He called the collapse of Bear Stearns and Lehman Brothers and the crisis in the Eurozone banking system. Reggie Middleton.
There's a lot of hype around blockchain tech, and the education comes from a myriad of places. So you have people who have no idea what it is, but they realize it. You have people who have no idea what it is, but they swear they know what it is. And then you have people who know what it is. And sometimes it's very difficult to pick. So I want to start at the lowest possible common denominator. So does anybody know what the blockchain is? Just raise your hand. Okay. So for those who don't know what the blockchain is.
You said don't know?
Don't.
Oh,
okay. Does anybody not know what the blockchain is? Raise your hand. Okay. So the blockchain is a database. It's a consensus database where transactions are stored, and everybody has to decide if those transactions are valid or not. If the majority of the participants, these are computer nodes, decide that the transaction is valid, it gets laid like a brick on the wall. Okay? And that's what they call a blockchain. A block is put in the chain. Every time there's a decision round, and everybody agrees that it's valid, then another brick gets put down. And then that decision is laid in stone as a layer. Layer 1, layer 2, layer 3. The more layers on top of that particular decision, the more solid that decision is. So what makes it secure is that there's a lot of horsepower needed to undo all these layers. Suppose you want to come in and say, instead of you sending a pencil to him, you want to say he sent a crayon to you. And you'd have to go with computer power and undo all of these layers. Okay, it takes a lot of computer power. Often there's a financial disincentive to do that because it will cost you more on computing power to do it than whatever reward you can get. So in general, there are many financial disincentives, which makes it very secure. Now, there's strategic incentives, but that's a different discussion. So it seems like I use a lot of words, even to me, because I'm listening to myself talk. But do you understand what the blockchain is now?
And a little, so I was at this conference earlier today, and a gentleman, he was supposed to be like a blockchain or whatever expert, but he said, so blockchain and then machine learning is different? Right.
Yeah, machine learning, blockchain. Just think of blockchain as a database where everybody shares decisions. Once they come to an agreement, okay, it's set in stone. And that stone gets deeper and deeper and deeper. Okay, does anybody know what digital currency is? I guarantee you everybody knows what digital currency is. This is easy. Let's pick somebody wealthy. Hedge fund guys. Okay. How much money do you have in your pocket?
I have no money in my pockets right now.
Okay. Do you have any money at all?
I mean, I keep my wallet in my office.
Okay.
I have maybe like 20 bucks on me.
Okay.
40 bucks, I don't know.
Do you have more money in that in general? Life savings?
Yes.
A lot more, a little more?
A lot more than $20.
Where is it?
It is in a bank somewhere.
So it's in the bank. Do you have big bags of paper sitting in a vault?
I do not.
You do not? Yep. So where is it?
It's sitting at Bank of America.
Where? Take a guess,
Where what?
Where is the money that you have sitting in Bank of America?
Oh, I think it's it's recorded electronically somewhere.
There you go. So digital currency.
Yeah.
Okay. Everybody who does business or any type of transaction, whether it's business or financial transaction, in a developed nation uses digital currency. Most of us use much more digital currency than physical currency. Unless you're very broke like me, where the $4 in your pocket is all she wrote. But, you know, digital currency is basic currency in a digital form. A lot of people are confusing digital currency with a new wave of technology, cryptographic currency, cryptocurrency, which uses technology similar to what's built, technology similar to what builds a blockchain to verify transactions. This new cryptographic currency is different because it has a lot of special attributes. So, as an example, I told you I have a few dollars. We have this $5 bill. This is fiat currency in the crypto world. Fiat, I think, is Latin, is it? For faith and belief in. So fiat currency is usually currency that's backed by the full faith of a government. This is a U.S. dollar, U.S. Federal Reserve note, $5. And this is backed by large amounts of atomic and nuclear bombs and a large standing army. And that is basically what gives this power. Just a quick note, the US dollar is a reserve currency of the world, a global reserve currency. And what makes a currency a global reserve currency is that country has the largest gun. Anybody who doesn't believe me, just think quickly back. Yeah, what was the last reserve currency before the US dollar?
Gold.
Gold, okay.
British pound.
The British pound. What made the British pound the...
They were the biggest army in the world.
Right. They had the largest standing navy and the largest guns. If you go before the British pound, all the way back, even back to the Roman days, you know, the Roman Empire, you know, I think it was a drachma, was it? No, that's Greek, right?
That's Greek. Yeah.
Whatever the Roman currency was, it was the reserve currency simply because they conquered everybody else and they didn't have a choice. So that's what makes this powerful. But if I'm going to give this to you, I have to reach over and give it to you. And now we have to rely on the fact that you give it back if it's a loan. If I were to send you money through a cryptographic means like Bitcoin, I could send it to you using a digital wallet, which is a piece of software on the phone, immediately. You can be sitting right there. You could be in Malaysia, and I can send it to you with the exact same effort, the same security. Digital cryptocurrencies have their own transportation rails. They don't need banks. They don't need money center banks, central banks. They need nothing but the blockchain that they ride on. Very, very special. What's also special about them is most of them are programmable. The first major digital currency, Bitcoin, has something called Bitcoin script, which allows you to program it and you can have it do special things. It has its own escrow system, multi-signature, short for multi-sig. So I can give you this dollar, but when I give $5, I'm sorry, but when I give you that $5, I can separate ownership, possession, and custody. I can trifurcate it, not bifurcate it. So normally, whoever has that as a bearer instrument has it. But I can give that to you, but I can make it so you can't spend it. So I can still have ownership of it. You can have possession of it. I could give him custody of it through the multi-sig system. Okay, and you could do even more things, very special things. These are all free attributes of using cryptocurrency, and Bitcoin was the first, one of the most basic. Then you've had offshoots, what the people call alternate coins or altcoins, and that's when you have Ethereum, which was founded by somebody very local, Joseph Lubin's, right in Brooklyn, you know, not too far from us, and they have taken the Bitcoin script system and they've expanded it. So it's now a full Turing programming script, the language, and they market it as a world computer. So instead of just being a currency you can send back and forth, it's literally a computer where you have shared computing resources. You can do a lot of wonderful things. Okay, so I got into this because I had an advisory service. My claim to fame was I was very good at valuing companies, and I can tell when CEOs were lying, usually because their nose started growing. It's not hard. And I used to be a real estate investor. I bought properties downtown. I had a .com, and then the real estate bubble became ridiculous. You know, 1 + 1 started to equal like 49. And I'm not good at math, but I know it's not 49. Whatever it is, it's somewhere still in the single digits. So I sold off my real estate portfolio, and I told myself I want to short every single entity that ever did business with me. Insurance companies, the banks, and everybody. I made very good money in the real estate, at least from a return perspective, you know, very good money. I took a year off. We had his little baby sister, and in the meantime, I wanted to start a hedge fund. Right about 2007, when this happened, the hedge fund, how you doing? Okay, press is here. Right about 2007, the hedge fund started collapsing. And so I wanted to start a hedge fund to short everybody, but even though it was a good idea, it was a bad time because the hedge funds were having a problem keeping assets. And they were getting a lot of redemptions because the real estate bubble was cracking. This was very easy to see. So I wrote a blog. I started writing on Neil Rubini's blog. He's a NYU professor turned entrepreneur. He's, you know, and he saw that 1 + 1 = 49 as well. And he had suggested that I write my own blog. So I started writing my own blog simply to give a market presence to who I was. Since I was going to start a hedge fund, I didn't come from the typical Goldman Sachs, prop desk, Harvard MBA. The blog was very popular, and it got so popular people were harassing me. sending me emails in the middle of the night, being belligerent because I wouldn't answer them. So I said, it's getting excessive. So the best way to get somebody to leave you alone is what?
Charge them money.
Exactly. When you ask them for money, people won't speak to you at all. So I put a paywall up. I heard crickets for 3 days, good night's sleep. One day, the third day, my phone rang, and it was Morgan Stanley. And they said, if we wire you $10,000, would you turn on 3 of our prop traders? Of course I would. So that actually paid my expenses. I had to hire my own analyst because I, didn't digest sell-side analytics well. And that, assuming I could keep that pace going, helped pay my expenses. And that's how Boom Bust Blog was started. So the Boom Bust Blog was very interesting because we caught Bear Stearns about 6 months before it collapsed. We caught that Lehman Brothers General Growth Properties, which is the second largest of the REITs, Countrywide, Washington Mutual. We caught almost everybody but AIG. And it was my fault for AIG because I knew the chairman, had a lot of respect for him, and that, blinded me to what was actually going on. During this time, or shortly after, about 2010, 2011, I had a small coterie of my clients were asking me about Bitcoin. And I'm like, I don't have time to play with, toys and Bitcoin, etc. But one day I decided to take a look at it. So I went to the Bitcoin wiki and I read it and my jaw dropped. And that's when I was reading about things like digital money that had its own transportation rails, it's programmable, smart contracts, basically self-executing computer contracts. And I was like, wow. So I did my due diligence and I found there was no business built upon smart contracts. When you hear blockchain, that's the big buzz, but the real power behind this technology is to create self-executing agreements that can't be broken, smart contracts. That is the wave of the future, mark my word on that. So I did it, I started a company based upon smart contracts, and what we did was I took an ISDA agreement, which is International Swap Dealers Association agreement, basically a contract, a blank contract that's a vanilla contract that says this is how you should create a swap agreement. I think it's about 86 to 92 pages. 99.5% of that basically prevents you from screwing you. So if you have a system that's counterparty risk-free that you can't hack, you eliminate almost all the verbiage. I had about 2 paragraphs, and I created a digital swap system that allowed you to trade value. I use a digital data feed that shot into the system, and it replicated the functions of an investment bank, a brokerage. So through the system, you were able to trade about 25 to 35,000 tickers, all asset classes, okay, with leverage, with no counterparty risk or credit risk whatsoever, almost instantaneous settlement. And I did this simply by using Bitcoin and Bitcoin technology. So, I thought I was proud of myself. This was about 2013, 2014. We put patent applications, around the world. But I believe we were ahead of our time because it wasn't really sticking. I was excited, like, wow, can you believe what digital money does? And a lot of people weren't getting it. They were still thinking in terms of wallets and remittances. Now, fast forward a couple of years, and you have more of the finance and technology and business world coming in, and now they do get it. Or at least they are coming closer to what I see as what the nirvana is. And so we're porting our system from Bitcoin over to Ethereum, which is that World Computer Network. Major difference being Bitcoin was first and has more value financially. I'll explain how the value works, and then we're going to talk about valuing tokens and then valuing the parties that issue tokens. Bitcoin, I think, it's about what? Maybe $20 billion in
market cap value. Now is closer to 30, I think.
30?
Yeah.
$30 billion. This is up from literally nothing in 2010. It was a white paper in 2009. I think Bitcoin traded like fractions of a penny initially. I remember it was 2,000 Bitcoin to order a pizza in 2010. Now Bitcoin is trading at about what? 17, should be like 18. So. Okay, so 2,000 to order one pizza to one Bitcoin order gets you what, 1,600 pizzas. So it's a pretty good gain, roughly 30,000%. That's really a good ride. The value of Bitcoin primarily is network effect. When you do a platform token, which is what Ether is, which is a token for Ethereum, or Bitcoin is, which is a token for Bitcoin. The token for Bitcoin is a lowercase b. The blockchain platform is a uppercase b, so it's Bitcoin and Bitcoin. With Bitcoin, the majority of the value is network effect. Okay, the fact that so many people use it and standardize upon it relative to the other tokens. Significant. And then the technology behind it is the other portion of the value. So right now, Bitcoin has that much network effect and that much technology or utility value. Okay? You go over to Ethereum, which was maybe $1 billion to $2 billion, had a very recent ramp up. Now I think it's about $9 billion and change. And it went from $2 billion to $9 billion in the last 2 weeks, 3 weeks, something like that. Not necessarily a bubble, and we'll discuss that in a minute. Ethereum has significant utility value, okay? Because it can do more literally than Bitcoin. It's moving faster because of a different culture, but it's also hitting a lot more road bumps, but it's growing faster. They have more of the mindset of, break it and fix it versus go slow and steady. So 2 different cultures. So utility value here, okay? And then platform economics here. Because Ethereum is growing so fast, they're expanding their platform economic value, okay? And Bitcoin, once they get rid of the internal politics, is actually expanding their technological value. They're soon to be on the cusp of adding technology that allows them to scale and compete with Visa, MasterCard, and the processors. So those are the 2 major platforms. There are many others like Dash and Monero.